Hey everyone, welcome back for another deep dive. Today we're going to be talking about some stocks that are, well, let's just say they've seen better days. We're looking at AMD, e.l.f. Beauty, and Robinhood, all of them hanging out near their 52-week lows.
Yeah, not exactly the usual all-stars you hear about, right?
But here's the thing, we're basing this on the analysis of a financial expert who actually sees this as an opportunity. This analyst thinks these stocks could be poised for a comeback. Oh, and one more thing, the source material for this is in French.
Oui.
But don't worry, we've got you covered with all the important details translated. So let's jump in. What's this analyst's strategy here? Why are they focusing on these underdog stocks?
Well, this analyst is what you would call a contrarian investor.
Contrarian, meaning?
It means they kind of like zig when everyone else zags. They buy when everyone else is selling and sell when everyone else is buying. And lately, they've been shifting their focus away from those safer defensive stocks and moving more towards growth stocks.
Growth stocks, the kind that are, well, supposed to grow a lot.
Exactly. But specifically, they're looking at growth stocks that have taken a bit of a beating, dropped 20% to 50% from those all-time highs.
So they're bargain hunting. Yeah, I can get behind that. But it's more than just picking up stocks at a discount, right? What's their approach?
Yeah, they're not just passively buying shares. They're using a technique called selling put options.
Okay, that sounds a little complicated. Can you break that down for us non-finance folks?
Sure. Think of it like this. They're basically making a bet that these stocks are going to go up in price. By selling these put options, they're essentially giving someone else the right to sell them the stock at a certain price.
So if the stock goes up?
They win. They get to keep what's called the premium, the money they got for selling the option.
And if the stock drops below that set price?
Then they're obligated to buy the stock. So there's definitely a risk involved, but it's a calculated risk, one that shows they're pretty bullish about these companies.
Okay, so it's a calculated gamble. I like it. All right, let's get into the specifics, starting with AMD Advanced Micro Devices. This one's had a rough year, down 53%. And our analyst initially gave it a buy call when it was trading at $120, but now it's down to $98. Kind of makes you wonder if they jumped the gun, right?
Yeah, you could say that.
No.
But AMD's recent earnings report might tell a different story. They actually beat earnings expectations.
Really? Despite the stock being down?
Yep, they reported earnings per share, or EPS, of 19 cents. And analysts were only expecting 8 cents.
Wow, quite a difference.
Plus, their revenue also topped forecasts, hitting $7.1 billion.
So even though the stock price is down, they seem to be doing all right business-wise.
Right, and if you look at their valuation, it gets even more interesting. AMD is currently trading at 21 times its forward earnings.
Meaning?
It's one of the lowest points it's been at, historically speaking. For every dollar of expected future earnings, you're paying a pretty low price for AMD stock, especially when you compare it to, say, NVIDIA, which is trading at 25.5 times forward earnings.
So AMD is kind of a bargain compared to its competitor. Okay, I see where this is going. But what about actual growth? Is there potential there?
Oh, absolutely. AMD is projecting some pretty impressive growth. We're talking 42% in 2025 and 24% in 2026.
Wow, those are some serious numbers. But wait, I remember you mentioned something about a slowdown in their data center and AI segment. Isn't that a cause for concern?
Well, yes and no. There's definitely some concern that growth in that segment might be slowing down a bit. But even with that slowdown, they still saw a pretty impressive year-over-year growth of 69%. So it's still a major growth engine for the company.
All right, so AMD financials are decent, valuation is attractive, and the growth projections look pretty good, even with that slight slowdown. Makes you wonder why the stock's down, right?
Well, the market can be a fickle thing. But let's move on to our next company, e.l.f. Beauty. Now, this one's had a bit of a roller coaster ride, going from a top performer to struggling a bit lately. It's currently trading around $64 after hitting a low of $58.
So I'm guessing our contrarian friend sees this as a good time to buy.
You bet. Their target buy price for e.l.f. Beauty is $58, right around that recent low.
Okay, so why the dip? What's going on with e.l.f. Beauty?
The main issue is slowing revenue growth. They used to be soaring, with a 76% growth rate.
That's huge.
It was. But now, projections are showing it dropping to 27% in 2025 and then down to around 10% in 2026.
Ooh, that's a pretty big drop.
And that's the reason their valuation multiple has taken a hit.
So basically, investors are less willing to pay a premium for future earnings because that future growth seems less certain. But hey, if our analyst is right and the stock bounces back, there's a chance for a big payoff, right?
Oh yeah, definitely. The analyst is projecting e.l.f. Beauty to reach an EPS of $5.87 in 5 years. And with a projected price-to-earnings ratio of 20, the stock could potentially hit $117.
Almost double the current price. Now that's what I call a contrarian bet. Buy when everyone else is doubting and potentially make a killing. But let's be real. Is that kind of growth realistic with such a big slowdown on the horizon?
That's the big question, isn't it? It all depends on whether those projections are accurate. And that depends on all sorts of things: consumer trends, competition, and e.l.f. Beauty's ability to keep innovating and adapt to the market.
So while the potential reward is there are definitely risks involved. This one seems like it would require a lot of research before jumping in. Speaking of risky bets, let's move on to our last company, Robinhood. This one's been all over the place, down 61% from its high, but up 133% this year alone. Talk about a wild ride.
Yeah, volatility is the name of the game with Robinhood, but they do have an impressive user base: 25 million funded clients.
That's like.
About 10% of all adults in the U.S. Pretty impressive read.
That's a lot of people trusting them with their money.
And their recent quarterly revenue growth reflects that a whopping 115% increase.
Sounds like they're on a roll.
But there's a but. A lot of their revenue comes from those quick, short-term trades, the kind that are heavily influenced by market swings and that whole crypto roller coaster.
So it's exciting growth, but tied to some pretty unreliable things.
Yeah, their future is a bit up in the air because of that. To put it into perspective, $672 million of their revenue came from those transaction fees, while $296 million was from that steadier interest income. So they're very dependent on people actively trading, which makes them very sensitive to any kind of market hiccup.
So a double-edged sword kind of situation. High growth, but also high risk. Where does our analyst stand on this one? Do they think Robinhood can pull through?
They do see potential in Robinhood, definitely.
Yeah.
It's not just about their current user base either. Their total addressable market is massive. We're talking $600 billion. Plus, they're branching out, trying to diversify what they offer.
Diversify, you mean like moving beyond just stock trading?
Exactly. They're getting into crypto, expanding the brokerage services internationally, and even testing the waters with banking and credit cards.
Wow, so they're trying to cover all the bases. But does that really solve their main problem? Relying so much on those unpredictable trades.
That's the million-dollar question. While all those new ventures are definitely promising, their main business model still depends on people actively trading. So Robinhood is still a riskier investment compared to companies with more stable and predictable ways of making money.
Okay, so even with all the new things they're trying, there's still a lot of uncertainty about Robinhood's future. It's like our analyst is betting on their ability to navigate through those market storms.
Exactly. High risk, high reward, as they say.
Well, we've covered a lot of ground already. It's clear these three companies are all trading low right now, but they each have different strengths, weaknesses, and challenges. I find it super interesting how this analyst is using that contrarian approach, looking for the hidden gems that everyone else seems to be overlooking. But before we jump to any conclusions, I think it's important to look at some different perspectives too.
Absolutely. It's always good to get the full picture and see things from multiple angles. It helps us make better decisions in the long run.
So I gotta say, as we've been going through all this, I'm really struck by how much this analyst is focused on the long term. It seems like they believe these companies will bounce back, but they're not expecting it to happen overnight.
Yeah, definitely. They're in it for the long haul.
Right.
And that's actually, a hallmark of a lot of successful investors, right?
Mm.
It's not about those quick gains, those flashes in the pan. It's about finding those companies that have a solid foundation and then being patient, letting those investments grow over time.
Totally. It's like planting a seed and watching it grow.
Yeah.
But patience doesn't mean ignoring the risks. And like we talked about, some of these companies, Robinhood especially, come with a whole lot of risk attached.
Oh, for sure. Putting your money on market swings and crypto, it's a recipe for a roller coaster ride.
Right.
And even for companies like AMD and e.l.f. Beauty, which might seem a little safer on the surface, they still have their own set of challenges that could trip them up.
You're right. So like with AMD, they're in a super competitive field, going up against giants like Intel and NVIDIA. Yeah, they've been doing well lately, but who knows if they can keep that up in the long run. The tech world changes so quickly, and there's always a chance some competitor will come out of nowhere with some amazing new product or innovation that shakes things up.
Exactly. It's not just about how a company's doing now. It's about their ability to adapt to the market, to stay ahead of the curve. Kind of like surfing. You got to stay on top of the wave. And with e.l.f. Beauty, That slowdown in their revenue growth, it's a real yellow flag. I mean, the analyst thinks they'll bounce back, but are those projections even realistic given what's happening in the market? Like consumer tastes are changing all the time, and let's be honest, the beauty industry is super competitive.
It makes you wonder what those projections are actually based on. Are they banking on some big product launch or hoping to grab a bigger share of the market? Those are the things I'd want to know before putting my money down.
Absolutely. And this is where doing your own research is key. Don't just take an analyst's word for it. You got to dig into the company's financials, look at industry reports, try to understand those bigger trends that could impact their future. It's like detective work.
Right, so patience is important, but so is being informed. Knowing what you're getting into and understanding those potential risks, it's like a balancing act. You got to be optimistic, but also realistic. Hope for the best, but prepare for the worst, right?
100%. It's all about recognizing both the potential upside and the potential downside. That's smart investing. And don't forget, there are things that can impact a company's performance that they have no control over. Those external factors, things like, the overall economy, interest rates, even global events, those macroeconomic forces can really shake things up.
It's like trying to predict the weather, right? You can look at the forecast, but there's always a chance of a surprise storm that changes everything. And those storms could be anything, from a sudden drop in consumer spending to some kind of geopolitical event that throws a wrench in supply chains.
Totally. It just shows how interconnected everything is. Investing isn't just about understanding a company. It's about understanding the whole world around it and how all those larger forces play a role in shaping the market. Oh, and we can't forget about consumer sentiment. This is especially important for a company like e.l.f. Beauty. They live and die by their brand image and what consumers want. If people start to turn away from their products or if their brand takes a hit, it can be devastating to their bottom line, even if their financials look good on paper.
Yeah, it's a good reminder that numbers don't tell the whole story. You got to understand how the market works, the psychology behind it, the emotions that drive consumer behavior. And those things can change so fast, it's hard to keep up. Like trying to predict the next big trend. Sometimes you nail it, sometimes you miss.
Exactly. And that's why it's so important to be flexible, to adapt to changes in the market.
Yeah,
You have to always be learning and adjusting your strategy.
that's a good point. This whole conversation has really highlighted that investing is an ongoing learning experience. There's no magic formula, no set it and forget it approach. You got to constantly learn new things, question your assumptions, and be open to new information and trends.
Couldn't agree more. The more you know about the companies you're investing in, the better equipped you'll be to make smart decisions and ride those market waves, both the good and the bad. Sometimes the best lessons come from those investments that don't go the way you hoped.
You mean learning from your mistakes? Oh, I've definitely been there. Buying a stock that seems like a sure thing only to watch it tank. But those experiences are valuable. They help you gain insights, refine your strategy, and become a better investor.
It's like they say, experience is the best teacher, but sometimes the tuition is pretty high.
Well said. I think that's a great place to wrap up part 2 of our deep dive. We've delved into some really important considerations today, going beyond the surface to understand what could make or break these companies.
We've explored the analyst perspective, but it's just one piece of the puzzle. Now it's your turn. What are your thoughts? What have you learned from this discussion that you can apply to your own investing?
It's been really interesting breaking down this analysis with you. It's so easy to get caught up in the hype, thinking about all the money you could make and forgetting to look at the whole picture.
Yeah, it's easy to get tunnel vision, especially when everyone's talking about a particular stock. But like we've seen with these companies, even those that are struggling can have potential. You just got to dig a little deeper, look beyond the surface, and see the bigger picture.
That's what I find so interesting about this analyst's approach. They're a real contrarian. They're not afraid to go against the crowd, to see value where everyone else sees nothing but risk.
It's a good reminder that the market doesn't always make sense. A lot of times it's driven by fear or excitement, and those emotions can really push stock prices away from what a company is actually worth. Those are the moments, those times when everyone overreacts. That's when contrarian investors can really make some smart moves.
But like you said before, it's not just about buying any stock that's down. You got to do your research, weigh the potential gains against the risks, and make sure it aligns with your own goals and how much risk you're comfortable with.
Exactly. And that brings us back to one of the most important things in investing, diversification. No matter how good a stock seems, you should never put all your eggs in one basket.
Right. It's about spreading your investments across different things, different types of assets, industries, even different parts of the world. That way you can reduce the risk and make your portfolio more resilient.
Think of it like building a house. A diversified portfolio is like a house with a strong foundation. It can withstand those storms that are bound to come along because the market is always going to go up and down. But if you're diversified, you'll be able to ride those waves a lot smoother.
That's a great analogy. It makes you realize that investing is about more than just picking individual stocks. It's about having a plan, a strategy that helps you reach your goals and build financial security. And, we've talked a lot about the potential of these three companies, but at the end of the day, the decision of whether or not to invest is a personal one.
Absolutely. We've provided the analysis and different perspectives, but it's up to each individual to decide what level of risk they're comfortable with and if these investments fit into their overall plan.
So, as we wrap up this deep dive, here's what we want you to think about. What are your key takeaways from our conversation? What will you do differently as you think about potential investments?
What questions will you ask yourself before making that buy or sell decision? Remember, being an informed investor means understanding both the potential rewards and the risks. It's about finding that balance between the excitement of potential profits and a healthy dose of caution.
And maybe most importantly, never stop learning. The market is always changing, there's always something new to learn. Stay curious, stay engaged, and keep exploring those companies and industries that you find interesting.
Couldn't have said it better myself. That's a perfect way to end our deep dive today.
Thanks for joining us on this journey of exploration. We hope you've gained some valuable insights that will help you navigate the world of investing. See you next time.